The market has wrapped up its active hours for the day, and as of the closing bell on Tuesday, June 16, 2026 at 4 p.m. Eastern Time, Rivian Automotive Inc. is sitting at an exact closing price of $15.93 per share. This represents a crisp intraday decline of 4.50%, with the equity shedding 75 cents over the course of the session on a trading volume that outpaced its recent rolling averages. While the headline tickers on major financial channels focus entirely on a minor workforce reduction that hit the tape, the real narrative playing out under the hood is a dramatic shift in how institutional allocators are valuing production scale versus capital preservation. The casual observer looks at a 2% headcount reduction and sees distress, but the sophisticated capital tracking this equity recognizes that the organization is aggressively cleaning up its corporate ledger to protect the unit economics of its newly deployed vehicle architecture. The broad sentiment framing this enterprise has always been centered on whether it can successfully bridge the chasm from a boutique builder of premium overland vehicles to a mass-market manufacturing powerhouse. For months, retail investors logging into their online investment accounts or scanning popular investing sites have bought into the idea that the commercial release of a lower-priced model would immediately act as an equity tailwind. The reality, however, is providing a harsh lesson in manufacturing mechanics. Bringing a $45,000 vehicle to market does not instantly repair a balance sheet that has been leaking cash to the tune of hundreds of millions of dollars each quarter. Institutional desks utilizing the Interactive Brokers platform or executing large block trades through Fidelity Investments are adjusting their models because the structural cost of building out infrastructure in locations like Georgia remains an immense capital drag that cannot be masked by initial consumer delivery milestones. This tension between what the public expects and what the operational numbers state is precisely why the equity has experienced such sharp daily swings over the last 2 weeks. When customer deliveries of the mid-size platform officially commenced earlier this month, the initial reaction on retail platforms like the Robinhood app was a mixture of enthusiasm and immediate profit-taking, causing a volatile multi-day correction before a modest recovery materialized. The market narrative wanted a flawless victory lap, but the financial reality showed that the cheaper variants meant to drive massive volume are still far out on the horizon, leaving the company to rely on higher trim packages to absorb immense overhead costs. Professional wealth managers reviewing individual brokerage accounts are forced to weigh this execution risk against the broader macroeconomic backdrop, where global supply chains are still feeling the squeeze of maritime shipping disruptions that have periodically throttled parts components since late winter. If you peel back the layers of recent trading data, the institutional footprint tells a story of cautious accumulation mixed with aggressive options hedging. On any standard Fidelity trading platform or advanced Interactive Brokers trading interface, the call-to-put ratios over the past 30 days reveal that big money is positioning for a prolonged period of consolidation rather than a vertical breakout. Large-scale mutual funds and institutional portfolios are not treating this like Tesla stock, which historically enjoyed an almost irrational premium based on retail fervor, nor are they treating it like legacy operators such as Ford. Instead, the asset is being viewed as a highly specialized technical asset that is being valued strictly on its path to positive gross margins. The immediate consequence of this sober evaluation is that any piece of corporate news, whether it is a strategic partnership with charging networks or a minor corporate restructuring, triggers amplified reactions across the board. Let us unpack the actual structural mechanics of the business model to understand why these short-term movements are occurring with such high velocity. The entity operates as an integrated designer and builder of category-defining electric vehicles, relying on a direct-to-consumer sales framework and a proprietary ecosystem that spans software, financial services, and commercial fleet management. Historically, the revenue generation has been heavily weighted towards its high-end consumer truck and SUV models, alongside a massive commercial delivery van contract that provided a stable baseline of demand. However, operating an automotive business requires an extraordinary amount of upfront capital, a reality that anyone engaged in self-investing quickly learns when looking at capital expenditure lines. The fixed overhead required to run assembly lines, maintain service centers, and source battery cells means that until production throughput crosses a critical threshold, every unit rolling off the line technically carries an associated burden of unabsorbed manufacturing costs. To put this into perspective for your own portfolio strategy, consider how you approach asset allocation on platforms like SoFi Invest or through automated solutions like Schwab Intelligent Portfolios. When a platform analyzes an industrial equity, it evaluates the balance sheet strength alongside the operational runway. The balance sheet here features a substantial cash buffer, yet the burn rate required to sustain research, design, and factory construction means the clock is constantly ticking. Earlier annual reports highlighted billions in net losses, and while recent quarterly reports have shown sequential improvements in narrowing those losses, the dropped timeline for adjusted profitability has forced a recalculation of terminal value models. Analysts who once published aggressive price targets are now focusing heavily on the bill of materials, calculating exactly how much cost can be engineered out of the physical chassis before the next major production ramp occurs. Comment below how many shares of Rivian you currently hold in your portfolio, and whether you are buying this dip or waiting for further stabilization. The responses to corporate adjustments like the recent employee cuts show exactly how fractured the investing community is right now. On one side, you have individual participants utilizing Robinhood stock trading who view cost-cutting as a proactive step towards fiscal responsibility and a vital mechanism for achieving unit-level profitability. On the other hand, traditional macro analysts reviewing the data through a Fidelity brokerage lens worry that trimming headcount within the service and customer organizations could inadvertently slow down the brand's ability to support an expanding fleet of vehicles on the road. Maintaining a high-quality user experience is paramount for a premium brand, and any friction in the service pipeline can severely damage consumer retention. Looking ahead, the trajectory of the equity will be defined by how reality navigates a few very specific operational catalysts. The primary milestone to watch over the coming quarters is the manufacturing throughput of the manufacturing ecosystem and the progression of the secondary production facility. Until the secondary plant comes online to provide the massive volume needed to absorb corporate overhead, the corporate margin profile will remain highly sensitive to component pricing and factory utilization rates. Furthermore, institutional interest will likely be influenced by how effectively the brand can monetize its software layer and fleet management services, features that represent high-margin recurring revenue streams that could offset the cyclical nature of automotive hardware sales. If the organization manages to execute its production milestones without requiring massive dilutive capital raises, the current valuation gap identified by discounted cash flow models could offer a substantial margin of safety for long-term allocators. Conversely, if inflationary pressures persist, or if consumer demand in the mid-size premium segment softens due to broader economic tightening, the pressure on cash reserves will intensify, forcing the market to reprice the equity towards its more conservative asset value floors. Navigating this landscape requires ignoring the surface-level noise of daily headlines and focusing squarely on execution metrics, unit economics, and structural cost reductions. Ultimately, the divergence between market expectations and financial reality is what creates commercial opportunity in the equity space. The public narrative frequently swings between unbridled optimism regarding the clean energy transition and severe pessimism over manufacturing hurdles. By maintaining an analytical framework anchored in capital efficiency and production economics, investors can move past emotional trading patterns and view the equity for what it truly is, a high-stakes operational scale play navigating the most capital-intensive sector in the modern industrial landscape. Turn your attention to the upcoming production reports, as those verified volume figures will provide the ultimate reality check for the expectations currently baked into the share price. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.